Hey, welcome to the Mortgage Minute for April 29th. It's the end of April and spring is here. Beautiful sunny day in Vancouver, which means the start of the spring housing market. And it is full on right now, at least in our market here in Vancouver. There's a lot of sales activity. And with that comes rate announcements. And Stephen Pulitz, the Bank of Canada governor, has come out and basically said expects inflation to stay low. Translation, no rise in interest rates. Wow, that's not shocking news. That's the same news we've been telling you for 4 years. So, still no change there. What is news this week? My voice is cracking. What is news this week is the fact that CMHC came out with a new announcement that they're going to tighten their rules yet again. It seems like every spring they want to come out and tighten the rules again. If it's not Ottawa, now it's CMHC. This year they're targeting second homes. And as some of you may or may not know, there is a second home mortgage program. So it used to be that if you had a house and you want to buy a second house, whether it's a recreational property or a house for your son or daughter, you could buy that and use it as a second home mortgage insured by CMHC and put as little as 5 or 10% down. Now, there was a loophole here that people started to take advantage of. Number one, it was intended for people to buy a home that their son or daughter or a relative was living in, but some people use it as a way of skirting the rules and getting into a rental property with 5% down. The other loophole that was happening is individuals would buy a house, live there for 1 year, put 5% down on that, and then 1 year later say, oh, I don't like that, I'm going to move, and they then go and say, now I'm going to convert my first house into a rental property. The second house becomes an investment. So, the second house becomes the new owner-occupied, and they can put 5% down on that. So what CMHC is doing is saying, no, we're on to you, we're not going to allow that anymore. So the new rules state that no one is going to be allowed as of May 30th to hold two high-ratio insured mortgages. Now, please understand, that does not mean that if you're a parent that you can't help a son or daughter get into a home if they're going to university and you want to, basically act as a co-borrower. You can still do that. You can still do that with only 5% down, as long as your house is not high ratio and still insured. So Joe Oliver, the successor to the late Mr. Flaherty, has signaled that he actually wants to play less of an active role in a real estate market, which was good news to the mortgage and real estate community. However, CMHC was also been mandated to, what was the terminology here? Ensure that its activities ensure that their activities contribute to the stability of the country's financial systems. In other words, Ottawa's really making sure that CMHC is not acting as an influencer, helping Canadians utilize low interest rates by making it easier for them to get into more and more debt. So that's going to be an ongoing concern. One of the casualties in this latest announcement was also self-employed. If you're self-employed, Ottawa and CMHC are going to crack down on that. You must provide verifiable proof of your income from a third-party source. So we may see the era of stated income mortgages for self-employed falling by the wayside. So how does this impact you? What does this mean to you? If you have any questions, I'm happy to answer them because it'll impact everybody in different ways. Some of you it has no impact at all, some of you will. If you're not sure, please send us an email or feel free to call me directly. Go to peterkinch.com and send us an email. We're happy to answer your questions and analyze your personal situation. So always something happening in the market, but that's it for this week. We'll talk to you again in a few weeks. Thanks. Bye for now.